This question tests the difference between absorption costing and variable costing, one of the most important topics in managerial accounting. The key distinction is the treatment of fixed manufacturing overhead, FMOH. Absorption costing treats fixed manufacturing overhead as a product cost, so it is included in inventory and expensed only when the goods are sold. Variable costing treats fixed manufacturing overhead as a period cost, so the entire amount is expensed in the period incurred regardless of production or sales. As a result, the difference in operating income between the two methods arises from the amount of fixed manufacturing overhead deferred in or released from inventory. If inventory increases, absorption costing reports higher income because some fixed overhead is carried in inventory. If inventory decreases, absorption costing reports lower income because previously deferred fixed overhead is released into expense. Units sold and units produced multiplied by the unit sales price. Incorrect. Sales price affects revenue, not the costing difference between absorption and variable costing. B. Ending inventory in units and beginning inventory in units multiplied by the budgeted fixed manufacturing cost per unit. Correct. The income difference equals the change in inventory units multiplied by the fixed manufacturing overhead per unit, reflecting the amount of fixed overhead deferred or released. C. Ending inventory in units and beginning inventory in units multiplied by the unit sales price. Incorrect. Inventory changes affect deferred fixed overhead, not sales revenue. D. Units sold and units produced multiplied by the budgeted variable manufacturing cost per unit. Incorrect. Variable manufacturing costs are treated as product costs under both methods, and therefore do not create the income difference. Correct answer, B. The difference in operating income between absorption costing and variable costing is explained by the change in inventory units multiplied by the fixed manufacturing overhead per unit, since only absorption costing includes fixed manufacturing overhead in inventory. This question tests the concept of variable costing, direct costing, and, specifically, which costs are treated as inventoriable, product, costs. Under variable costing, only manufacturing costs that vary with production are assigned to inventory. These costs become part of inventory on the balance sheet and are recognized as an expense, cost of goods sold, only when the products are sold. Students should distinguish between product costs and period costs. Product, inventoriable, costs under variable costing, direct materials, raw materials, direct labor variable manufacturing overhead period costs under variable costing, fixed manufacturing overhead, expensed immediately, selling and administrative expenses, both variable and fixed. The key difference from absorption costing is that fixed manufacturing overhead is not included in inventory under variable costing. Instead, it is charged against income in the period incurred. Therefore, the correct answer must include only variable manufacturing costs. A. Only raw material, direct labor, and variable manufacturing overhead costs. Correct. These are the inventoriable costs under variable costing because they are directly associated with producing each unit and vary with production volume. B. Only raw material, direct labor, variable and fixed manufacturing overhead costs. Incorrect. This describes absorption costing, where both variable and fixed manufacturing overhead are included in inventory. C. Only raw material, direct labor, variable manufacturing overhead and variable selling and administrative costs. Incorrect. Variable selling and administrative costs are period costs, not inventoriable costs. D. Only raw material and direct labor costs. Incorrect. Variable manufacturing overhead is also a product cost and must be included in inventory under variable costing. Correct answer, A. Under variable costing, inventory includes direct materials, direct labor, and variable manufacturing overhead only. Fixed manufacturing overhead, and all selling and administrative expenses are treated as period costs and expensed in the period incurred. This question compares variable, direct, costing used for internal reporting with absorption costing used for external financial reporting. The primary distinction between these two methods is the treatment of fixed manufacturing overhead, FMOH. Variable costing, FMOH, is treated as a period cost and expensed immediately. As a result, operating income depends primarily on sales volume, since inventory contains only variable manufacturing costs. Absorption costing, FMOH, is treated as a product cost and included in inventory until the goods are sold. Consequently, operating income is affected by both production and sales, because producing more units than are sold defers some fixed overhead into inventory. Students should identify which statement correctly reflects these differences. Remember that selling and administrative costs are period costs under both methods, and external financial statements prepared under absorption costing normally report gross margin, while internal variable costing statements emphasize contribution margin. A difference in the treatment of fixed selling and administrative costs. Incorrect. Fixed selling and administrative costs are treated as period expenses under both costing methods, so there is no difference. B. A higher inventoriable unit cost reported to management than to the shareholders. Incorrect. Absorption costing, external reporting, includes fixed manufacturing overhead in inventory, so external inventory cost is higher, not internal inventory cost. C. A contribution margin rather than gross margin in the reports released to shareholders. Incorrect. External financial statements prepared under absorption costing present gross margin, while contribution margin is generally used only for internal management reports. D. Internal income figures that vary closely with sales and external income figures that are influenced by both units sold and productive output. Correct. Under variable costing, income depends mainly on sales volume, whereas under absorption costing, income is affected by both sales and production because inventory can defer fixed manufacturing overhead. Correct answer, D. Variable costing links income closely to sales, while absorption costing allows changes in production and inventory levels to influence reported operating income through the treatment of fixed manufacturing overhead.